Sir, I have some experience in the stock market, but commodity trading feels very confusing to me. MCX, gold, crude oil, futures, options, everything sounds complicated.
That's completely normal. Most traders feel the same initially. Commodity trading looks complex on the surface, but once you understand the structure and logic, it actually becomes simpler and more systematic than equities.
Let's start from the basics. What exactly is MCX?
MCX stands for Multi-Commodity Exchange of India. It is a regulated exchange where commodities like gold, silver, crude oil, natural gas, and base metals such as copper are traded in the form of contracts, not physical goods.
Why should someone trade commodities instead of stocks?
Three main reasons. First, commodities are global instruments, so they react strongly to international news. Second, they offer high liquidity and volatility, which is good for traders. Third, commodities are excellent for hedging against inflation, currency movement, and geopolitical risks.
Which commodities are most popular for trading?
The most actively traded ones are gold, silver, crude oil, natural gas, and copper. Gold and silver are safe haven assets. Crude oil and natural gas depend heavily on global demand supply, and copper is closely linked to global economic growth.
I hear a lot about futures. What exactly is a futures contract?
A futures contract is an agreement to buy or sell a commodity at a fixed price for a future date. You don't pay the full value, you pay a margin, which is a small percentage of the total contract value.
So margin means leverage, right? Is that risky?
Yes, margin gives leverage. Leverage increases profit potential but also increases risk. That's why risk management and stop loss are non-negotiable in commodity trading.
What about options? Call and put confuse me a lot.
Think of it simply. A call option gives you the right to buy if you expect prices to go up. A put option gives you the right to sell if you expect prices to fall. As an option buyer, your loss is limited to the premium paid.
Which is better, futures or options?
Futures are direct and fast-moving but risky. Options are safer for beginners because of limited risk. Professionals often combine both depending on market conditions.
How important is international data in commodities?
Extremely important. Gold reacts to US interest rates and the dollar. Crude oil depends on OPEC decisions and geopolitical tensions. Natural gas is influenced by weather and inventory data. Commodities move globally before Indian markets react.
So economic news matters a lot.
Yes, inflation data, interest rates, US Federal Reserve decisions, crude inventory reports all directly impact commodity prices. Ignoring global data in commodities is like trading blind.
Should commodities be traded intraday or for long term?
Both are possible. Intraday traders focus on volatility and news. Positional traders focus on global trends, seasonality, and macro data.
What is the biggest mistake beginners make?
Overtrading and ignoring risk. In commodities, capital protection comes before profit. Small position size, predefined stop loss, and discipline are the real edge.
If someone is starting today, what should be their first step?
Start with understanding one commodity deeply. Learn its global drivers, contract structure, and behavior. Trade small, stay consistent, and focus on process, not quick money.
This actually made commodities feel logical and structured.
That's the goal. Commodity trading is not gambling. It's a skill based on data, discipline, and global understanding.